I am a tutor that assists with your financial reporting and analysis and all of the different modules that you guys are doing at your university. So last week, we started to do some free classes for you guys, and I highlighted that we'll be doing on different days certain modules. So far, we have done free classes for financial reporting and analysis. We have done for macroeconomics. We have done for introduction for project scope and scheduling. We have done for advanced, what is that one? Advanced programming concepts. I believe Yes, yes. So we've done all of those free classes. So you are still yet, I think there is one class that is two classes or three classes that are still missing. Business communication will be done this coming Sunday evening. We'll be doing business communication. And then next week, we will meet to do functional areas of management. So that will be the last free class next week for functional areas of management. After that, we'll only be considering those that are interested in the classes and those that are willing to pay for the classes. So today we want to look at our lecture number 2 for financial reporting and analysis. As I indicated last week, we did the theoretical aspects of the module where we covered unit number 1 last week. Most of the items under unit number 1, except a few items that we are going to cover today, were done last week. So we introduced to you what financial accounting is, and we compared it to management accounting, where we said financial accounting or financial reporting and analysis, it's mainly about record keeping. It mainly looks at how do we do record keeping within an organization. Then secondly, we also looked at the key financial statements that are found within an organization, where we discussed what is a statement of comprehensive income, what is a statement of financial position, what is a cash flow statement, and what is a statement of changes in equity. Then we close the lecture by looking at the concepts of accounting, the rules that we need to follow whenever we are doing accounting. So today is still going through the introduction. The reason why I focus at least 2 classes on introduction is once we are done with introduction, I'm going straight to the question papers. We'll actually be doing past exam papers. So from next week up until the end of the semester, everything that we are going to be doing will literally be in your exam. So you will need to pay attention. But for you to understand the question papers, you need to have an understanding of what is accounting terminology. You need to understand what I mean when I say this is an asset, what I mean when I say this is an income, what I mean when I say this is an expense. Right. So today, that's what we want to look at. We want to look at key terminologies in accounting and what they mean. And then we want to have an overall idea of the bookkeeping experience of an accountant within an organization. Once we do that, then from next week, then we prepare the financial statements. So for example, next week, we're going to be doing the comprehensive income statement, which is a question that is going to be in your exam at the end of the semester. All right, so let's go straight into today's business. So today we are going to look at 3 things. We are going to look at how do you classify accounting information. Then number 2, what is the accounting equation in the double entry system. Then number 3, how and where you record accounting information. The last part there, we are not going to focus too much energy on it because it's rarely in your exams, and also it's more fitted for the guys that are doing BCom accounting. So the guys that are doing BCom accounting, next week we are going to separate you from this class because we need to teach you how to actually record, how to do the journals, how to do the bookkeeping, the books of original entry, and etc. That is for the BCom accounting guys. But for the rest of the class, we go straight into financial statements, we go straight into your exam preparation. All right, so the first thing, what are the different classifications of accounting information? So in your study guide, I believe that is unit number 7. So there are 5 key terms or 5 keywords that you need to understand in accounting. And again, if you have a question, if there's something that I say that you do not understand, feel free to ask. You can unmute, you can post on the chat, feel free to ask so that we make sure that you understand these things the first time around. So there are 5 key terms that you need to understand when you're doing accounting. So that is what is an asset, what is a liability, what is equity, what is expenses, and what is income. Right. So when we are talking about an asset, we are talking about something or a resource that has an economic value to a business, right? It has to be something that you control. So when I'm saying a resource that is economic value that you control. So for example, if as a business you have a building and the building is yours and you can rent out the building to tenants, it means it's a resource of economic value that you control that is going to generate a future benefit for your business. That's an example. Or, for example, if you have a business, right, and in your business you've got a vehicle, a car, and you can use the car maybe to go and do sales calls or maybe to deliver your products, whatever the use that you have in the business. But again, you're saying it is a resource that is of economic value that you own that you can use as a business to generate income for the business. So that is what we call an asset. So the essence of having an asset in an organization is number one, you have to be able to control it. Then number two, you should be able to generate future income or a future gain or a future revenue from that particular asset. So that's the essence of what an asset is. So an asset can either be tangible or it can be intangible. When I say an asset is tangible, I'm saying that you can touch it. For example, a building, for example, a car, for example, cash, right? You can touch the asset, right? That's tangible. Then when I say an asset is intangible, it means that you might not be able to touch that particular asset, yet it is an asset to the organization. Think of a company such as Coca-Cola, the organization Coca-Cola. The name Coca-Cola is actually an asset to the organization Coca-Cola. Why? Because if they produce a drink right now and try to sell it without saying it was produced by Coca-Cola, no one will buy the drink. But if I produce a drink and I put the name Coca-Cola, suddenly a lot of people are buying the drink. So that's what we call intellectual property. Sometimes we call it goodwill. So that's an intangible, something that you cannot touch, but yet the business controls it and it gives the business a future economic gain at the end of the day. So an asset can be tangible or intangible. Then an asset can either be fixed or uh, are current. So when I say fixed asset, in other words, most textbooks will use the word non-current assets, right? So when we're saying an asset is fixed, or when we're saying an asset is a non-current asset, we are saying that it is a long-term asset. So for example, if you buy a building as a business, you expect to use that building maybe for the next 20 years. So that's a long-term asset. If you buy a car as a business, you expect to use that car for the next maybe 5 years. So that is a long-term asset. But if you buy, for example, um, if you were to buy what is the stationery for your business, right? If you were to buy some stationery, some pens, that you want to use and etc., you expect to use those assets maybe within 1 year. So they no longer are considered long-term assets. They are now current assets because you are expecting that this asset will be used up within the following 12 months. So if an asset is going to be used up within the following 12 months, it's considered a current asset. Whereas when an asset is going to be used up over the next 10 years, 5 years, 3 years, and etc., anything above 12 months is considered a non-current or a fixed asset. So that's the classification of assets. So you will notice here, I've got a list of examples. of assets here, and then I said as a homework, create a table and categorize whether these assets are tangible assets, intangible assets, current assets, and non-current assets. And I have a little table there. So the answers to the homework are already there. Right. So you guys can, in your spare time, you can go through all of these. I'll just pick one or two, which I think are important. But in your spare time, you can go through this. You can read through this. The reason why you need to do this is when we start doing the income statement, when we start doing the statement of financial position, etc., you are going to see these words. You are going to see these key terms coming up. So you need to understand that when I say the company has got a prepayment, what am I talking about? When I say the company has got a data, what am I talking about? So let's talk about this first, right? What do I mean by this? So when a business is operating, for example, if you take Mr. Price as an example, the company that sells clothes, Mr. Price, right? So you can either go with cash to Mr. Price and pay them with cash or a swipe, and they give you your clothes, right? You have paid, right? But sometimes you can tell them, look, I don't have money, I can pay month end. And then they open an account at Mr. Price. So you take the clothes, but you don't pay the money right now. You pay it after 30 days or after 60 days, and that's called opening an account. So the moment a customer comes and buys products from you, but does not pay you the money right there and then, that customer is known as a debtor, someone who owes the business money, or is known as accounts receivable. Those words are used interchangeably. A debtor or accounts receivable. It means it's an account that someone opened that you as the business you are going to receive in the future. So that is considered an asset. Why? Because we expect that this person will pay us the money within the next 12 months. Because most accounts are usually 30 days or 60 days or 90 days. So we expect that the customer is going to pay us within the next 12 months. So it's a short-term asset, which we called a current asset. So under current assets, you are going to find these accounts receivables. You are going to find cash, physical cash, or money in the bank. That's another current asset. You are also going to find a stock, the clothes that you are selling at Mr. Price. Those that stock, we usually call it inventory, right? Inventory or stock, that's still also a non-current asset, because when Mr. Price puts clothes in the shop, they expect to sell those clothes within the next 12 months. So those are examples of non of current assets. That is stock, inventory, cash in the bank, or debtors or accounts receivable. Then there are some interesting words that you might see that may be used by your lecturer. So, for example, for cash, your lecturer may use the word bank. So, cash means physical cash. Bank means money in the bank. They are used interchangeably because it's the same thing. But also, you might find the word cash and cash equivalents. This word, what it simply means when you say cash and cash equivalent, we are saying this is either physical cash in the bank, or it is money in the bank, right? Or it is a short term investment. So, for example, if I go and open a fixed deposit account with FNB where I deposit the money for 2 months, I can't touch it, but after 2 months, I get the money back. That's a cash equivalent or a short term investment. It is also considered as a current asset. So you have to be careful. So if someone says, I have an investment can be long term or short term. If it is short term, less than 12 months, it is put under current assets. Usually we record it as cash and cash equivalents. Then, if an investment is for more than 12 months, then we consider it to be a non current or a fixed asset. So that's something that you can also see that can happen. Then, this word here that says accrued income. Accrued income, we are talking about, is the same concept of debtors and accounts receivable, but usually we use it, for example, rent. Let's say that someone owes you rent. When someone owes you rent money, we usually don't call it accounts receivable or debtors. We usually call it accrued income. It's income that you were supposed to receive as a business, but it has not yet been paid to you. So that's accrued income. Or maybe you're supposed to be paid the commission and then you're not paid the commission as a business. We usually call that accrued income. So all of those things are part of your current assets. Then there is something that is also called a prepayment. This one can actually confuse you because you'll be thinking, but it's an expense. Why is an expense being put under current assets? So think of it this way. Let's say that as a business, you you have a certain expense that you accrue every month. For example, your water account with the city council, right? You use the water, you pay it at the month end. Then you decide as a business, we want to pay our water bill for the next maybe 2 years or for the next 5 years. So you go to city council, you send them a transfer of maybe, let's say, 30,000 to cover water bill for the next 2 years. But the honest truth is, remember, you have not yet used the water. It's water for the next 2 years. You've not yet used the water. Now, remember, last week we talked about the matching concept. We talked about the accruals concept. And we said you should match revenues and expenses. So the revenues and expenses of a particular year should be matched. So we cannot pay for expenses that are in the future and consider it an expense. It's not an expense, it's an asset to us as an organization. So if I take an expense and I pay for it in advance, usually you find that under water, under electricity, under insurance, under advertising. Those are usually the things that you pay for in advance. Insurance, advertising, electricity, water, rentals, you pay for them in advance. So if I pay for something in advance as a business, I consider the money that I paid in advance is considered to be an asset to me as an organization. Right. So just take note of it. You will see it when we start doing examples next week that any prepayment, any money paid for in advance is considered to be an asset, a current asset, a prepayment. Right. So those are examples of your assets that you can see that are found within an organization. So that's definition of asset. Let's go to the next one. Definition of what is a liability. Right. So when we are talking about a liability, we are talking about something that you owe. So as a company, when you are operating, sometimes you have to take loans, for example, from a bank. So it means you owe the bank the money that you borrowed. So that is a loan that you took. So that becomes a liability to you as an organization. So a liability is when you owe someone or you owe another company in a specific amount of money and you are going to pay it in the future. Right, not current. If you're going to pay it right now, it's an expense. It's not a liability. But you are going to pay for it in the future. So I have taken 50,000 Rand from the bank. I'm going to pay it in 2 years' time. That becomes a liability. I went to my supplier and I said, guys, can you give me some products? I want to go and sell them, but I don't have money right now. I'll pay you in 4 months' time. That becomes a liability. So that's what liabilities are. Right? So liabilities, again, they reflect you owe people, but you are going to have to pay for it in the future, which means you're going to have a loss of value that is going to happen in the future of the organization. And then liabilities can either be current liabilities or non-current. When we're saying non-current, we're saying long-term. So if it's non-current, it's more than 12 months. We are saying that you're going to pay the person back after 12 months. But if it's current, it's within the next 12 months. You have to pay that money within 12 months. So again, I've got a list of different liabilities I have here in the homework that says categorize these liabilities as current and non-current. You can do that in your spare time. The solutions are already there in my homework answers there. But maybe let's talk about one or two of them, right? So that you can see what I'm talking about. So first thing, I'm sure you can see over here that there is a 1-year bank loan and a 5-year bank loan. 1-year bank loan means it's going to be paid within the next 12 months. It becomes a current. But a 5-year bank loan is paid over after a year. It becomes non-current. So always be very, very careful. Sometimes what your examiner or what your lecturer does is he can tell you this. He can tell you that you owe the bank 5 million, right? But within this 5 million, 1 million is going to be paid within 12 months. So how do you record that? Which means you need to split it. 4 million is going to be recorded as a non-current liability, whereas 1 million is going to be recorded as a current liability. So that's something that you need to be aware of, that sometimes one single amount of money can be split into two because of the nature of when it's going to be what? When it's going to be paid back. Most overdrafts, we regard them as short term because overdrafts are paid for within a year, right? Then if you see the word debenture, usually we consider it long term. If you see the word bond, it's usually long term. If you see the word mortgage, it's usually long term, right? Then there are some type of expenses that you are going to see that are quite interesting. So these are these ones over here, right? So this is when, as a company, you enjoyed a particular service, but you have not yet paid for it. So, for example, if we use water from the city council this month and decide not to pay it and then pay it in the year 2026, so it means that we owe the city council the water bill, right? So we consider that to be a liability. We call that accrued expenses. It's an expense that we enjoyed, but we have not yet paid. Or even like salaries. If we have not yet paid our employees' salaries for this year, we consider it to be an accrued expense. Or taxes. Let's say that SARS does an investigation and audit, says that we owe them maybe 100,000 Rand in a tax bill, but we don't have the money right now. We say we'll pay them in 2027. That becomes a liability to us. We owe tax payable. Or dividends. The owners of the business, they want profit from the business. We tell them we can give you 50,000 profit, but we have not yet paid it. We are waiting maybe for some cash, and that becomes a what? That becomes a liability. Or this one is interesting. Pay attention, right? Income received in advance. Let's say that we have a tenant, right? As a business, we have a building and we are renting out the building and we have a tenant in the building. The tenant is supposed to pay rent for 2025 only. But the tenant says, look, I have a lot of money right now in my account. I want to pay rent for the next 5 years. That tenant is now a liability to us. Yes, he has paid us rent. It's rent that he has paid for. But remember, the rent is for 2025, 2026, 2027, 2028. We are not yet in 2026. We are not yet in 2027. So those years that we have not yet done become a liability to us. Because he can come right now and say, give me my money back for 2026, and we have to pay him that money. So that becomes a liability. So any income received in advance becomes a liability to the organization, right? So those are liabilities, right? Okay, let's go to the next one. I see there's someone who posted a question. Let's see. Someone says prepayment, since it is an asset, is it also non-current? A prepayment is considered mostly as a current asset unless otherwise specified. Let me explain that. When we're saying prepayment, remember we're saying you have paid for in advance. Most people, when they pay for in advance, they only pay for a year in advance. It's very rare for you to find someone who's going to pay 20 years in advance. If they do pay 20 years in advance, yes, you can consider it as a non-current. But for the examples that you are going to do for the exam, take note, a prepayment will be a current asset. Take note, a prepayment will be a current asset. Income received in advance will be a current liability. For your exam examples, your lecturer is not going to make them 2 or 5 years. It's usually just say for the next 12 months or something like that. Okay, I hope you answered. All right, so we've done asset, we've done liabilities. Let's go to the next one, which is income and expenses. Right. So when we are talking about income within a business, we are talking about an increase in the economic benefits within the current year of operation. So when I'm saying increase economic benefits within the current year of operation, the basic explanation is to say sales or revenue. Right. So if I'm in the business of selling tables, if I sell tables, right, if I convert my inventory, my stock into cash, I've sold tables, then that becomes an income to me as an organization, right? So I have converted an asset immediately into cash for the business. That becomes an income for me as a business. So this is cash inflow that is coming in the ordinary course of my business. If I am in the business of selling books, the books that I sell generate income for the business. If I'm in the property business, the rentals that I receive generate income for the business. So, what is your ordinary course of business? That is very, very important. So, whatever you are receiving in your ordinary course of business becomes an income. And whenever there is an income, we consider it to be an increase in the equity. I'm going to talk about what is equity shortly, but income is considered to be an increase in the equity of the organization, right? It's a benefit to the owner of the business. But usually, for exam purposes, you are going to see income through mainly sales revenue, and then you're going to see things like rentals received and etc. We'll discuss them more in detail next week. Right. Then expenses. Expenses is whereby you are immediately losing value as an organization while you are operating. So, for example, we are saying that today when we were operating, we paid for fuel expenses. We lost cash for us to pay for the fuel expenses. We lost cash for us to be paid the salaries. We lost cash for us to pay for insurance today. So that is what we regard as an expense. It's a loss of value for the business on a day-to-day basis. For example, you're going to see that your assets are going to lose value. As you use the motor vehicles for the business, it's going to be losing value. That's depreciation, and that's an expense of the what of the business, right, at the end of the day. Then also, when we're talking about expenses, we also say expenses are a decrease in equity. Again, we're going to discuss what is equity shortly, but expenses are regarded to be a decrease in equity. So I have a list over here of different things that I've listed, which you can also categorize whether it's an asset, a liability, an income, and an expense. The reason why I do this is these are common terms that you are going to see within your exam. Your lecturer is going to say, okay, there is insurance, there is provision for bad debts, there is property taxes, there is advertising. So you just need to be aware what those things are so that you are able to classify them correctly when you prepare your statement of financial position, when you prepare your statement of comprehensive income, etc. So again, it's a little homework that you can go through to see if you are aligned. You can just fill in the form. Right? Then the answers are already there in the homework. You can see over there, I explained everything, what each and everything means at the end of the day. But let me talk about maybe a few interesting things. Maybe just one interesting thing. Do we have it here? The rest of it, you will see it next week when we do the example in class of a statement of comprehensive income. But for now, I want to introduce this thing here. This one here and this one here. This is one of the things that are quite difficult for students to understand. So I think it's better we also start talking about it right now. So when a business is operating, right, remember we said that they can offer their products on credit. Mr. Price can say, okay, you don't have cash, please take the clothes, you can pay us in a month. Some clients don't pay in a month. You guys know this. They end up blacklisted and whatnot. So those clients that don't pay, we consider those to be credit losses of the organization. Credit losses is a word that we use, or bad debts. That's another word that we use. So we are saying that there are customers that took our products but did not pay us. So that's a bad debt. That's an expense to the organization, or that's a credit loss. That's an expense to the organization. But however, there is a concept that we talked about last week. We said the conservatism concept. We said that if you're unsure about something, it is better to underestimate than to overestimate. So think of it this way. Mr. Price, at the end of the year, they notice that there is a client that owes them 10,000 Rand who has not yet paid the account maybe for the last 3 months. They don't know whether the client will pay the account or not. They are not sure. Maybe the client will pay the account. If the client is going to pay the account, then it's an asset for them, right? It's an accounts receivable. But if the client does not pay the account, it becomes a bad debt. But right now, when they want to record, they are not sure whether the person will pay or they are not going to pay. So they do an investigation. After the investigation, option number one, they find that the client is working, he just didn't pay. They can say, no, we will follow up on it, and they will record it as an asset. Investigation number two, they find that the client was fired from his job 3 months ago. So you can already see that this person has not been paying for the last 3 months. They were fired from their job 3 months ago. So it means that they have no other money. So it means that they're never going to pay us because they don't have a job. So that person becomes what we call provision for bad debts. We are saying we are not 100% sure whether this person will pay or not, but we can see that chances of them paying are going to be slightly difficult. So because of that, we create an account called provision for bad debts. We are going to discuss next week a little bit more about how to categorize that account, how to deal with it. But I just want you to have that in your head, that bad debt is someone who definitely did not pay us. Then provision for bad debts is someone who we are unsure of. So we want to provide for the eventuality that they might not pay us. Right. So that's something that you can also see. All right. Then last item here, we have got equity. All right. So under equity, we are saying, remember, we said an asset, right, is something, an economic resource of value to the organization, which is going to generate a future benefit for the organization. Then liability, we said that this is someone you owe money to as an organization. So when we are talking about equity, right, there are two ways of thinking of equity. One way of thinking of equity is think about the money that was invested by the owner of the business into the business. If I want to start a business right now and I have 300,000 Rand and I say I want to put 300,000 Rand into a shoe manufacturing business, the 300 Rand that I have put into the shoe manufacturing business is what we call equity. So that's one way of looking at equity from a layman's point of view. But from an accounting point of view, we say that equity represents whatever remains from the business after we have removed all liabilities. So I am saying that we have assets in the business. We've got buildings, maybe 500,000. We have vehicles, another 500,000. We've got furniture and fittings and whatnot, maybe 200,000. And our business, the value of our business is 1.2 million Rand. Those are the assets that are in the business. But then we owe the bank 600,000. So which means that from that 1.2 million that we have to pay the bank 600,000. So the money that is remaining after we pay the bank becomes what is ours as the owners of the business. So that's what equity is. So equity represents the outstanding assets or the outstanding claim on assets after all other liabilities or after all other external claims have been made. Now, equity is recorded differently depending on the nature of your business. If you are looking at a company, you will find that they will say equity, they will be talking about the shareholders of the company, the ordinary shareholders of the company, the preference shareholders of the company, what is the retained earnings of the company, what is the capital reserves of the company. We will talk a little bit deeper about these things later on. Okay? That's still equity. Then if the business is not a company, if it's a small tuck shop that you have, it's not a company, you do not register it, you're just selling some small groceries as a tuck shop. Equity, usually we use the word capital, right? Which means this is the capital that I have invested in the what? In that particular business. So that's equity in general. So again, in layman's terms, for you to understand it, it's just the money that I invested in the business. That's what equity is. But remember what I said in the previous slide. I said income of the business increases equity. Expenses of the business decrease equity. So as your business is operating, if it makes money, it means that the owner of the business is benefiting his equity is increasing. If the business is making losses, it means the owner of the business is not benefiting. The business is making losses. The money is being lost in the what? In that particular business, right? So that's our equity for you. Right. So that brings us to an end of the key terms that you need to understand for you to be able to hear me out when I'm talking about what financial accounting is and etc. So just what we have done so far, right? You are now at a position whereby we can start doing past exam papers together. Of course, I'll be teaching you what each stage you're going to do, what are the steps and etc. But just what we've done so far, you should have an ability now to understand. If you see a word, you should know what that word means. If you see a word where it's written, this is the uh, buildings of the business, you should be able to say, oh, a building is an asset. If I say, oh, this is the loan of the business, you should be able to say, oh, the loan is a liability of the business. And so, oh, these are the shareholders of the business. You are saying, oh, shareholders are the equity of the business. If I say, oh, this is the rent for the business, oh, this is an expense of the business. If I say this is sales, you say, oh, this is income for the what? For the business, right? So now we want to go into the mechanics of accounting, the physical mechanics of what accounting is. Right? So this is the foundation now to the statements that we are going to do next week and etc. But this part, it's more applicable to the guys that do, accounting than it is to you guys. But it is good for you to understand this, because when I explain certain concepts next week, if you don't understand this, it may be difficult for you to understand what does he mean by this. Right? So the first thing is there is something that is called the accounting equation. Right? The accounting equation is just a principle in accounting, which remember we talked last week of the concept of double entry. Right? So the accounting equation in accounting is the principle that supports what we call double entry in accounting. So when we're saying double entry, we are saying that everything in accounting is recorded twice. How is everything recorded twice? Now, I want you to think about this. The accounting equation, in short, it says assets is equals to equity plus liabilities. That's the accounting equation. But I want you to think about it as a layman, as someone who doesn't know accounting. Remember, when we said assets, we said these are your buildings, your cars, your cash, and etc. investments. This is what you have. This is everything that you have as a business. Then if I say it's equal to equity and liabilities, I am saying it is equals to how did I get those assets? Right? Remember, equity represents the money that I put into the business, and liabilities represents the money that I borrowed for the business. So for me to get a building in the business, either I bought the building using my own cash or I bought the building using a loan from the bank. So assets is equals to equity or liabilities also means whatever we have as a company should always be equal to how did we buy it? Did we buy it using equity? Did we buy it using liabilities? Or the value of the company is equals to how did we finance this company? Did we finance it through an issue of shares, or did we finance it through debt, the capital structure of the company? So whenever you record anything in accounting, it affects this equation. So as an example, we are going to go through a deeper example in a minute, but I just want you to get what I'm saying. As an example, if I say I'm going to record an asset of 1 million for the company on one side of the equation, right? I come over here and I say I want to record that I have a building of 1 million this side. Immediately you're going to ask me equals to how did you buy that building? And I say, oh, I took a loan from FNB. They gave me 1 million. So it means that I have a loan of 1 million. So 1 million is equals to 1 million. So that's what it is. The double entry. That's what we are talking about when talking about double entry. We're saying that you have to record things twice. It will become more complicated later on, but that's essentially what we are talking about. All right, so let's go a little bit deeper. So this is not for the guys that are doing BCom accounting. We are not yet doing T accounts. We will do that later. The T accounts, even maybe next week. This I'm still just explaining the accounting question. I'm not doing T accounts here. Don't confuse T accounts with the issue of the dub of accounting question that I'm talking about here. Right. So let's look at it, my first example. Right. So this one, where I say visualization, this is an example of number one, this shows the accounting equation. Then number two, this is an example of the statement of financial position, the actual statement of financial position that we are going to learn. I think we'll do it in about 2 or 3 weeks time, right? But this is just an example. Right? So the statement of financial position, also known as the balance sheet, is based on the accounting equation. So remember, we said assets is equals to equity and liabilities. Do you see that on this diagram, there are two things. There's assets on one side, total assets. Then there's equity and liabilities on the other side, total equity and liabilities. So this is a visual representation of what a balance sheet can look like. Of course, it's simple, but I just wanted to show you visually what we are talking about. So as an example, suppose you as a business person, you have saved 100,000 Rand and you want to invest in a car wash business and you open a bank account for the business. If someone says, I want my accountant to record this for me in my books of accounting, I'm not talking about the journals, I'm just talking about the statement of financial position in relation to the accounting equation. How is someone supposed to do that? I'm going to record that I now have an asset, right? You can see there, under assets, I have current asset, cash, 100,000, because cash is a current asset, right? Then I will also record I now have equity and liabilities. Under equity and liabilities, do you see the equity, the capital contributed, 100,000. So the equity is equal to the what? To the assets of the business. So assets is equals to the equity and liabilities of the business. So that's an example. Let's make it a little bit more complicated, right? Number two, remember the car wash business that we wanted to start. You want a property where you can do the car washes, where your customers can come. So you don't have the money, you go to FNB. FNB approves a mortgage loan for you. They tell you we can give you 900,000 for you to get your property. They give you 900,000, you get your property. So what changed? Do you notice? Now you have got another asset. Initially, you only had one asset of what? Of 100,000. Now you've got another asset here, which is property with 900,000. So what is now your total assets? Your total assets are now 1 million. But when you added plus assets, what did you also do? You also took a loan from FNB plus non-current liability of how much? Of 900,000, because you now owe FNB 900,000. So what is your total equity and liabilities? It's 100 plus 900, which is 1 million. So do you see? You are still, assets is equals to equity and liabilities. They are still equal, right? You go a step further, right? You decide that you also want equipment. You also want, some vacuum cleaners, some pressure washers, some, a lot of equipment. And this equipment is durable equipment, which you can use for the next 5 years. Durable equipment, which you can use for the next 5 years. But you don't have money, you don't have cash right now for that equipment. You only have 100,000 in the bank. But you go and negotiate with the supplier. Maybe it's Builders Warehouse. You tell them, look, guys, can I pay you in 90 days? Can I pay you for the equipment in 90 days? And they approve the account. So which means you now have another asset. Remember, you had the property for 900. Now you have property and equipment under your non-current there. It's now 1.1 because there are two things there, property and equipment. But also, you now have got a current liability of 200,000. If you add everything up, do you see 1.2, 1.2 on both sides, right? Again, we go further. Right. Now you want to open. On the first day of your car wash, you see, oh, I really need some dishwasher. I really need some sunlight. I really need some soaps to clean the cars because you didn't have that thing. So you quickly go and buy some soaps to clean the cars for the day, right? You have everything in order. You start cleaning the cars. So that's an expense because you are saying that you want to use those things immediately. You buy the soap. You want to use the soap right there and there, and it ends up even finished by the end of the day for you to operate the business. So that is your expenses that you have that you have done as a business. So those expenses, what happens? You have used cash to buy those expenses. So your cash is no longer 100,000. It is now 90,000 because you've subtracted the asset of cash. But remember what we said? We said expenses reduce equity. So which means your equity is no longer 100,000. Your equity is also now 90,000. So that's what we're meaning when we said expenses reduce equity. So whenever you have an expense, it reduces the equity of the organization. And again, you can see that you're still balancing out the accounting equation. And then your first customer comes. The first customer comes, you clean up their car, and after cleaning up their car, they pay you 1,000 Rand. That's revenue. That's money that you are receiving. Again, because it's money, it's cash, it goes to the what? To the bank account. So you now have 91,000. 90,000 plus 1,000. And then remember, we said income increases the capital of the business. So, which means the what? The equity of the business is no longer 90,000, it's now 91,000. We have added 1,000 to the capital of the business, right? So it goes on and on and on and on and on, right? You are always affecting something as the business is operating on a day-to-day basis. There is something about the business that is going to be affected. You can see here an example. Suppose you choose to pay the bank 50,000, right? Remember, you owe the bank 900. Now you want to pay them 50,000. What are you going to do? You're going to use cash to pay the bank, right? So which means your cash is going to be reduced, but also your non-current liabilities are going to be reduced. The debtor, the person who owed you money, decides to pay. What does it mean? It means the asset of the debtor is reduced, but the asset of cash is increased at the end of the day. So that is what we talk about when we are talking about the accounting equation and its effect, the effect of different transactions on the balance sheet or on the value of an organization. Right? So that's the basic stuff. Now, the last part for today's lecture, right? I'm not going to go deep into this part. The guys that are doing BCom accounting, this is what you will be doing next week. For the guys that are doing BCom accounting, it will be a separate class. This is what you'll be doing next week. For everyone else who is not doing BCom accounting, I am just highlighting this because you need to be aware of it, but it's not going to be really in your exam. The stuff that is going to be in your exam, we are going to start working on it next week. Right. Now, when a business is operating, it is an accountant, a bookkeeper. So that's why I'm saying this is more relevant to the guys that are training to become accountants. Everyone else is not training to be an accountant. They're training to be different types of managers, but you just need to be aware. So when a business is operating, it is an accountant or a bookkeeper. A bookkeeper records the transactions that are happening in the business on a day-to-day basis. They record the transactions that are happening in the business on a what? On a day-to-day basis. Right? So where do they record these transactions? They are recorded in a book called journal. Journal is regarded as the book of original entry, where when let's say a customer comes in and they pay for a product, right? They pay for the car wash, they pay 1,000 Rand for the car wash. You record that transaction in what is called the sales journal, right? Then you send maybe one of your employees to go and buy some detergent, some sunlight at Spa for you to clean the car. You record that entry in what is called the purchases journal. So as you are recording these entries, they are debit entries and there are credit entries that you are recording. We'll talk about it briefly, don't worry. But you record these things in the journal. Every single day you are recording these things in a journal. Then at the end of maybe a month, right, you are going to take your entries from these journals and you are going to put them in what is called a ledger. Right, you're going to put them in what is called a ledger. Right, a ledger now is an account that gives you a summary of what happened in a particular part of the business. So, for example, you can have the sales ledger. The sales ledger will tell you all of the sales that happened for the year, and it will tell you that this year we made sales of 3 million, the final total sales ledger value. Right? So a ledger gives you what is happening in the business in total. A ledger, for example, you can have your asset ledger, right? Where you are recording your assets. You can, okay, I have got an asset account in my asset ledger and etc. So that's what a ledger becomes. But again, like I said, this is direct bookkeeping. It's more relevant to the guys that are doing BCom accounting. We are going to talk about with them next week in detail. But for you guys, we just talk so that you have a basic understanding of some of the things that are happening, what your accountant is doing. So as your accountant is recording transactions, they record transactions in three types of accounts, right? An account can be a personal account. When I'm saying a personal account, it's an account with the name of someone. So, for example, if someone owes you money as a business, you can open an account for Kuda where you record everything that James or everything that Kuda or everything that whoever owes money to the organization is going to what is owed the money. So you are recording in a personal account of that particular person. Then real accounts, these are accounts for like physical assets of the organization. For example, an account where you record the value of your buildings, an account where you record the value of your motor vehicles, an accounting where you record the value of your stock or the value of your cash. These are real accounts in a business. Then nominal accounts. Nominal accounts is where you record your incomes and where you record your expenses. Nominal account is actually what we are going to use next week when we do the statement of comprehensive income. So when you record these things, right, each and every account will have a balance. All right, so just give me a second here. I want to show you what I'm talking about. So you understand me? Don't worry about the actual record keeping. You don't need to really know this. But there's somewhere where I'm going, where I want you to understand so that we have a starting point next week. All right. But the actual accounting, don't worry about this. This is for the guys that do BCom accounting. They're going to do this next week. They'll be taught about it. But for you guys, I want you just to have a basic understanding. So, an account. So, a bank account is an example of a real account in a business. So remember, we said, for example, that you start a business, you have 100,000. So when you are recording in accounting, you are going to say capital, right? That is the capital that has been contributed by the owner of the business. And you're going to record it as 100,000 like this. But because of double entry in accounting, you can't record it one side. You have to record it elsewhere. So I'm going to go to the capital account and say, I got what? Cash, right? Or a bank, money that I put in the bank, 100,000. So this capital account could actually be a personal account, right? And this could be James owner capital account, because James is the owner of the business. So this is a personal account where I am recording that James deposited 100,000 in the business, right? Because he's the owner of the business. And then in the bank account, I indicate that we received capital of 100,000 to start the business. So you can see I have recorded two entries. But I want you to notice something. One of the entries is under DR, the other entry is under CR. DR means debit, CR means credit. We'll talk a little bit more about it next week when we do the trial balance and the income statement and whatnot. But I have recorded it twice. Then I use this money. Remember, we said that we use this money for example, all right, let me do this. Let me just create another one here. Oh yeah, there it is. So remember, we said that the bank gave us 900,000, right? So we received a loan, FNB, right? 900,000. So this is actually what your accountant will do. They will be recording. We received a loan, 900,000 from FNB, right? And then they'll go there and open an account for FNB. FNB loan account. FNB gave us a what? Cash loan of 900,000, right? Then what did we do with the loan? We bought a building. So which means if I bought a building, it means I have used the cash, right? So I bought a building. I'm going to say 900,000, right? I've bought a building. Then I'm going to go there and say under my buildings there, now I have a building that I bought by using money in the bank and it's worth 900,000. So that's your accountant on a day-to-day basis. He's doing his record keeping on a day-to-day basis. You don't need to worry about this part yet. At the end of the year, the accountant will then create what is called a trial balance. This is where I want you to understand me. This is what is important. A trial balance of the accountant is the accountant is saying how much money is in the bank account, how much money is in the building account, right? How much money is in the capital account, how much money is in the expenses account, and so forth. So he is listing each and every account of the business according to the balance that is left in that particular account of the business. So once he has done that, once he has listed each and every account in the business according to the balance, we have what we call a trial balance. A trial balance is a summary, right, of all of the accounts of the business. It's a summary of all of the accounts of the business and what they are, the value that they are in. Now, your exam for the guys that are not doing BCom accounting, everyone else that is in this class, your exam, you are going to be given the trial balance. You are not going to be asked to do what I was doing right now. You are going to be given the trial balance, the list of the balances. The lecturer is going to tell you that there is, all right, let me show you an example of a trial balance before we go further. Final trial balance, just give me a second. Financial reporting. So your lecturer is going to give you a trial balance. So this is an example of your exam situation, which is where we are starting off from next week. So we are done with the preliminaries, right? So your lecturer gives you this, all right? So this is an example. You see, this is an example of a trial balance. Do you see what I was saying? You see, balance sheet accounts, land and buildings, you can see how much money is in it. Is it debit or a credit? Vehicles, how much money is there? Is it debit or a credit? Inventory, how much money is there? Is it debit or a credit? Debtors control, how much money is there? Provision. So that's a list of balances. So you are not really going to learn how to record the transactions and whatnot. That's for the guys that are doing BCom accounting. We'll do that next week with them. But for you guys, you need to learn to take what has already been recorded, which is the trial balance, and then prepare the final statement of financial position, and then prepare the final statement of comprehensive income and etc. So that's the nature of your exam questions. And starting from next week on Thursday, That's what we are going to be doing. So we will be taking the trial balance and then preparing a statement of income, taking the trial balance and then preparing a statement of whatnot. But the reason why we had the two lectures that we had last week is so that when you see this word in the trial balance vehicles, you know what it means. When you see this word ordinary share capital, you know what it means. When you see this word sales, you know what it means so that you don't get confused why I'm talking about this. So you already know, okay, James, you told me that rates are expenses, carriage on sales are expenses, bad debts are expenses. So which means, but just looking at this, you can already tell that this is an expense, 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 this is an expense. So if I say prepare a statement of financial position, you already know, okay, I don't need this because this should not be in a statement of financial position. If I say prepare a statement of comprehensive income, where it says operating expenses, you record all of these things. Because why? Because they are all expenses. So I'm supposed to record all of the expenses in the statement of a comprehensive income. So that is the reason why we were building up the way we were. So next week, we are going to do our first financial statement, which is going to be the statement of comprehensive income. The statement of comprehensive income is we list all of the incomes that are in the trial balance and we subtract all of the expenses that are in the trial balance. That's a statement of comprehensive income. Right. So you will see, of course, it will be a little bit more complicated than that, but you will see it as we do it together. But from next week, that's what we will be doing. Right. Any questions? All right. If there are no questions, I'll see you guys next week on Thursday. So, like I said, from next week, we will be going through past exam papers. We'll just take a past exam paper question and then I'll show you. Okay, so in this question paper, you are asked to prepare an
Hi,
income
James.
statement. Yes?
Sorry, it's Shana here. I just
Mhm.
want to find out, can you please share these recordings with us? Is last week's recording as well? Is it possible for you to share?
Yeah, it's there in the group.
I haven't received it. Do you mind reposting both again so that it's just recent?
Okay, it's fine. It's okay. I'll resend it. Or maybe what you can do is you can just
Mm-hmm.
also send me an inbox. If you don't see it after the class, just send me an inbox. You guys have my number, I hope. 0713
Yes, yes, we
064.
do.
Yes. You can just inbox me if you don't see the notes or the video in the group. You can inbox me. Maybe you will not be in my group. I know there's a lot of groups that are out there. So you might not be in my group.
Yeah,
So
I think that's a
yeah, so you can
possibility.
just
Thank you so much.
okay, that's fine. So let's meet again
Mhm.
next week on Thursday. And like I said, guys, next week on Thursday is the last free class that I will be doing. After that, I'll only be dealing with those that are interested in paying for the services. So we still have some free classes going on, but next week, Thursday, is the last free class. The rest of August, we'll only be dealing with those that are willing to pay for the service. But we have one more free class for those that may not afford our services. All right, thank you.
Yes, James.
Mhm,
Good evening. Before you hang, could you
mhm.
kindly please share the question paper so that we can, when next week when we prep the question paper, maybe prior before the
No problem.
class.
No problem. I'll do
Yes, so that we can print. We are old fashioned,
that.
so
Okay,
that we
no
quickly
problem.
work on a question paper while you are talking. Then we are able to. Yeah.
To jot down notes. I understand what you're saying.
Yes.
I'll do that.
All
What you
right.
can do, let me give you also just a little homework because I tend to deal with a lot of students. I can easily forget sometimes. If you see that I did not send the question paper, can you yourself remind me? Just send me a WhatsApp message, James, question paper, and I'll make sure that I send it either tomorrow. I should send it tomorrow in the morning. I just
All
need to
right.
check
Thank you.
which
I'll
question paper
remind
we will
you.
do. All right. Thank you.
We're gonna work on it next week.
Yes.
Thank you. Thank you. Bye.
All right.